Welcome to today's webinar. My name is Scott Irwin, and we'll be conducting this webinar this morning with my partner, Darrel. And the title of today's webinar is entitled Crop Price Implications of USDA Grain Stocks and Prospective Plantings Report. Well, we want to get right to the material, and I'm going to start by taking a look at the USDA grain stocks reports and their implications for primarily old crop corn and soybean markets. The March 1st corn stocks that the USDA announced in all positions on and off farms was 7.808 billion bushels yesterday. The average trade guess going into the report was 7.801 billion bushels, so there was only a 7 million bushel difference. So the trade guesses on average appeared to be right on the mark as concerning that stocks number. In historical perspective, not surprisingly, that the 7 million bushel surprise, which is computed as the USDA announced grain stocks minus the average trade guess, the latest one at 7 million bushels is very small and pales in comparison to some of the really big surprises that we have seen in the last 7 or 8 years, as big as plus 386 and minus 217. So not a big surprise from that number. We can take that stocks number of 7808, and what we want to do is then subtract from the first half usage of known exports and other categories of use, and we can imply for the first half of the 15-16 marketing year the feed and residual usage of corn, and that first half usage is 3649 or 3.649 billion bushels. So that's a pretty hard number as far as the bushels on the old crop corn balance sheet that we used in the feed and residual category. The real question now is, what does that number, 3649, imply, if anything, about the total feed and residual use that we should project for the 2015-16. In other words, did we learn anything that would persuade us to change the current projection, which the USDA and their WSDA forecast has as 5.3 billion bushels for 15-16? So that's what we're going to take a couple minutes and walk through. The first way that we can think about trying to answer the question, what did we learn from that stocks and implied feed and residual usage for the first half of the year, is to ask a pretty simple question, which is, let's take the stocks surprise, which is what we have here on the X or the horizontal axis, and then say, historically, how does that stock surprise line up with the change in the WSDA feed and residual for the year from March to the final? In other words, in this case, if we get a stock surprise of a positive number, meaning that the USDA announced more stocks than we expected, so that would be 0 to 500 million on this chart, then that would imply that usage is not proceeding as rapidly as projected, and we should reduce the total feed and residual for the year. And so we would expect this relationship to have a negative slope. And if it was a perfect relationship, we would expect that the slope to be -1, the intercept be 0, and the R-squared to be close to 1. It's really interesting that what you in fact find is that, we do get the negative overall relationship between the March 1st stock surprise and subsequent adjustments in the annual feed and residual category by WSDA. But boy, the relationship does not fit very well. What this says is that stock surprise, even after going halfway through the marketing year, really doesn't tell you as much as I think most people think with regards to adjustments in the feed and residual category going forward. It does say, if you get a big positive surprise, you should drop it, but by how much, you can see varies tremendously. So that only adds to the point of the fact that our stock surprise on March 1st was pretty small at +7, but even at +7, notice on the chart, you can have subsequent adjustments in the WSDA feed and residual that's +100 to -100. So we just simply say take the stock surprises with a real grain of salt. An alternative way to ask how much do we know is to simply look at historical rates of first half disappearance and apply those to that first half number of 3649 and see what that implies for the marketing year feed and residual use. So, for example, from 1996-97 through 05-06, the average rate of first half disappearance was 64%. And if in 15-16 we were proceeding at that pace, the implied 15-16 marketing year feed and residual use would be 5.701 billion bushels. From 06-07 through 09-10, that jumped 4 percentage points to 68%. That would imply 5.366 billion bushels. And then we had a really big jump in that percentage of first half use to 74% for 2010-11 through 13-14. And that would imply feed and residual use for the year actually under 5 billion bushels. Last year, that percentage was 69%. And if we applied that this year, you would be at 5.288 billion bushels. So you have all those percents. We think that a reasonable assumption is that we will be someplace between that 68 and 69% for 15-16, which leads us to say that the current USDA 15-16 projection for feed and residual use for corn of 5.3 billion bushels seems pretty solid at this point. We just don't see anything in the data that would lead us to change that assumption. Okay, let's moving on now to March 1st stocks for soybeans. Those came in at 1.531 billion bushels. Interesting, a bit lower than what the trade was expecting. The trade on average was at 1.556 billion bushels, and we can put that in historical context. Maybe we would say, Darrel, that's kind of a modestly bullish surprise in terms of the typical market response. In this case, a red would be a bullish grain stocks figure, and the blue would be bearish. And so we had a moderately bullish number where it came in at 25 million bushels less than what we had expected in terms. So that means that soybean use may be, emphasize the may be proceeding a bit faster than the trade was anticipating. We have a similar situation in soybeans. When we look at the soybean balance sheet, we can think about first half and second half seed and residual use for soybeans. And now with the data from the March 1st grain stocks report, we can project that first half seed and residual use of soybeans was at 180.5 million bushels. And then the key question is, where's that going to end up for the remainder of the 15-16 marketing year. And you can see that the pattern is always a big positive in the first half and then a negative in the second half. So we think that a reasonable place to end up would be maybe something about a negative 30, 40 for the second half would put us for seed and residual use of soybeans for the current marketing year, someplace around 150 million bushels. So that's a run through on the grain stocks and where we might be proceeding on use on corn and soybeans. And I'm going to turn it over to Darrel now to look at the big acreage numbers.
Okay, thank you very much, Scott. I want to run through the prospective plantings for corn and soybeans and then move to the implications of what Scott has talked about and the acreage numbers for the balance sheets for corn and soybeans. When we look at first the prospective plantings report, we always ask the question, how big is the pie? How many acres are being planted in 2016 compared to last year? And I stole this chart from NASS, but it shows state by state expected plantings of all the principal crops in 2016, with the bottom number showing the change from last year. So the blue states are increasing acreage, the red states showing some decline. And so the pattern is a little more acreage in the central part of the Midwest, fewer acres probably in the plain states, excluding Nebraska there. When we look at the principal crop number in perspective, historical, USDA is projecting 317.3 million acres planted to principal crops, which would be 1.2 million acres less than last year, and certainly well off of the highs that we've recently seen, as high as 326 million acres in 2014. We add to this, kind of do the arithmetic on total acreage. We add to the estimate of principal crops the amount of land that we think will be in CRP based on enrollment as of last October. And then we also have to account on an annual basis for acreage that's reported as prevent plant. And so we're always curious at the bottom line here, what's happening to total acreage in this accounting sense from year to year. What we don't know for 2016, obviously, is what we will have in the way of prevented planted acres, if any. What we've penciled in is kind of a nominal number, minimal number of 2 million acres. And what that shows is when you do the accounting, total acreage adds to 342.7 million, which is sharply less than last year and certainly well off the highs that we've seen in recent years. I think the question that is raised here is it a surprise that principal crop acreage is down 1.2 million acres, given that we're coming off of a year of very high prevented planted acres? And that then suggests, are there acres missing from the estimate of principal crops? Can't answer that at this point, but I think it is, in my mind, a bit of a concern that there may be cropland acres not yet accounted for based on the March survey. We won't know that until June, but it is a caution flag, I think, that acreage probably will not be less than what's being estimated here in the March report. If we look at specifically at corn, of course, the big surprise in yesterday's report was the increase in corn acres to 93.6 million. That's considerably higher than the average trade guess of just under 90 million acres, and is about 5.6 million acres more than planted last year. So a big increase expected in planted and then, of course, of harvested acreage of corn. And when we look at that state by state, we see that it was pretty unanimous decision by producers to increase corn acres this year, with the big increases in terms of acreage, not necessarily percentage, but in total acreage coming in North Dakota, Kansas, Illinois, Iowa, we're seeing the big increases in corn acres, at least based on the March intentions. What we do know from history is that actual planted acreage of corn will likely differ from what we saw in the March report. This is a history of those differences going back to 1998. And we see kind of a random pattern here of years when acreage exceeded intentions and acres were less than. Last year we were 1.2 million acres less than intentions. Much of that is attributed to the prevent plant, the wet spring that we had last year. But it does open the important question of where corn acreage will actually end up this year. And so we asked the question, which way? And at this point, I think you might argue that planted acres could be a bit less than what was intended. We're seeing some, I think, fairly significant price response to yesterday's report that may change some decisions about how much corn to plant as wheat prices and soybean prices remain stronger, corn prices weaker. That may move some acreage away from corn to those other crops. And so at this point, if we had to speculate, we would expect to see acreage come in a bit less, and that will be reflected in one of our balance sheet scenarios here as we move through the slides. In the case of soybeans, we saw a bit of the opposite in terms of actual intentions versus expectations. Intentions at about 82.2 million acres, just slightly less than last year, about 400,000 acres, and about 800,000 acres less than what the market was looking for based on the average of the pre-report guesses. Again, state by state, we see where the increases and decreases are coming in intentions. The big increase is coming in Missouri, and that's not a surprise given the magnitude of prevented acres that was reported for Missouri last year. We're seeing a little more acreage in Illinois, a slight decline in Iowa, more of a mix here, obviously, than was the case for corn. We asked the same question on soybean acres. How will the final planted number compare to intentions? And that's been all over the board in recent history, all the way from almost 2.6 million acres less to almost 3.3 million acres more than reported in March. Last year, down almost 2 million acres, again, related to prevent plant in many cases. So how will the final number stack up? I guess we would argue that we might see a few more soybean acres, depending on what kind of weather we see for the rest of the spring and how the price ratios unfold. But certainly the initial reaction, I think, will push perhaps a few more acres towards soybeans away from corn, as I indicated earlier. So let's move to the old crop balance sheets, and the question we're asking here is, do we want to, in our minds, change anything in the balance sheet compared to what the USDA was saying in its March 9th WASDE report? So that's the first column showing acreage, yield, production, total supply, consumption by category, ending stocks, and average price. In the second column is our current thinking about how we might change those projections. And as Scott indicated, we didn't see enough evidence in the stocks report to change the projection of feed and residual use. We're leaving that at 5.3 billion bushels for the time being. But we do see seed and industrial use perhaps a bit higher than the USDA projected, and that's all coming in the ethanol market. We are seeing currently about a 4% year-over-year increase in ethanol production on a weekly basis. We're also seeing gasoline consumption domestically increasing, so that we think that with everything now being blended at 10%, that the increase in gasoline consumption along with continued strong exports of ethanol perhaps will push that total about 25 million bushels higher than the USDA projected. Exports were leaving at 1,650,000,000 bushels. I think there is a lot of discussion about are we really on pace to reach that? Certainly in the first half of the year, we were not. We were looking at a very slow pace of export shipments, but that has accelerated in recent weeks. And when you adjust the weekly export inspection numbers for Census estimates of exports to date, we would say that we probably now are on pace for reaching the 1.65. We need to ship, according to my calculations, we need to ship about 39 million bushels per week. And that's what we've been doing the last couple of weeks. So the challenge will be to maintain that pace. I think the sales are sufficient to support that. So we're leaving that number at 1.65, would then result in a slightly smaller forecast of ending stocks, about 25 million bushels less, but would not change our price expectations since the crop year is about half over. Much of the crop has already been sold. It's going to be hard to change the average price much from that 360 level. On the new crop balance sheet, we start with the Prospective Plantings report, and then we'll go from that to saying how many acres of corn would we expect to be harvested for grain. And this shows the history of the difference between planted and harvested. It varies quite a bit, primarily depending on what kind of growing season we have and how many abandoned acres. But on average, over the last 20 years or so, that has been about 7.6 million acres going to silage or abandon. The other question we'll ask in terms of putting together the balance sheet is what's the expected yield for 2016? We'll start with a calculation of trend yield. This shows you the history of what we would call the unconditional trend yield, just a linear trend of actual yield since 1960. As you can see, yields have increased about 1.8 bushels per acre per year, with that trend line having an R squared of almost 90%. There's a couple nuances in the way we calculate actual trend yield. Without going into all that detail, we would say that our trend expectation would be 166.2 bushels for the 2016 crop. So we can then go to the balance sheet for the new crop. We repeat the numbers for the 2015-16 marketing year, and then the second column is a projected balance sheet based on Prospective Plantings, 93.6, harvested acres of 86 million, 166.2 bushel yield. It would give us a total supply of over 16 billion bushels of corn. On the consumption side, we ratchet feed and residual use up based on a large crop and expected low prices. We would ratchet ethanol use up another 75 million bushels based on, again, continued low gasoline prices and increased gasoline consumption. We would see a slight increase in exports based on some current concerns about the South American crop, as well as more favorable currency ratios in the coming year. So we would see total consumption ratcheting up to just under 13.9 billion bushels, leaving ending stocks of just under 2.3 billion, 16.5% stocks to use ratio. And based on our stocks to use ratio and price model, we would see an average price of about $3.50 for corn for the upcoming marketing year based on that scenario. The third column is a scenario based on our expectations of how reality might differ from prospective plantings and trend yield. I've reduced planted acres by 1.5 million. I've reduced yield in this column by about 5 bushels, and this is based on some of our work that we've been publishing at Farm Doc Daily on the potential impact of the current El Nino episode, and we're simply saying that we see an elevated risk of yields falling below trend in 2016. And if that would happen, then what we're showing, of course, is a smaller crop, smaller supply. We would reduce our consumption forecast modestly in the feed and residual category, smaller ending stocks, 1.659, and an average price that would be about $3.70 based on our stocks and price model. Quickly on soybeans, the old crop balance sheet, the only thing we would change relative to the USDA's most recent projection is we might bump up the export projection just a bit based on the current pace of shipments and the level of outstanding sales. I think we can do a bit better than what USDA is suggesting here. That about 10 million bushels higher than USDA. On soybeans, we tend to harvest most of the acreage that are planted. Over the long term, the average difference between planted and harvested is about 1 million acres. We calculate a trend yield for 2016 under the same procedure that we do for corn of 45.2 bushels. And so the balance sheet would look like this based on prospective plantings and an average yield of 45.2 bushels. We would see, interestingly, a total supply of soybeans identical to what we had in 2015-16. I hope that the math is right there. That seems like an odd coincidence. On the consumption side, again, we would perhaps ratchet up domestic crush a bit as well as exports from what we're seeing this year. Total consumption up 60 million bushels, stocks down 60 million, and a price just a bit higher than what we experienced this year. The alternative scenario of more acres, but a slightly lower yield based on the risk that we see associated with the demise of this strong El Nino episode, would give us a slightly smaller crop, a slightly smaller supply. We don't think the change would be enough to alter our consumption projections, and so we would leave consumption at 3.76, ending stocks 293, and an average price of about $9.20. So I think for both right now on corn, what we see in the marketplace is the market is offering an average price for next year of about $3.50, which is consistent with our balance sheet based on prospective plantings and trend yield. And the market is offering a price a bit over $9 now, I think, for soybeans based on current futures prices. So the market is kind of somewhere between our different scenarios here on soybeans. Just wrap this up before we get to the questions. What we're seeing in summary is March 1 corn stocks about equal to expectations. Doesn't change our expectation for feed use. Farmers intend to plant a lot more corn, somewhat fewer soybean acres, well above trade guesses on corn, a bit below on soybeans. So the implication is we look for a bigger corn crop under either scenario, slightly smaller soybean crop. Our best guess is that corn stocks will stabilize near the level expected for this year, and soybean stocks could decline somewhat. pointing to somewhat lower corn prices and higher bean prices in 16-17. So with that quick overview, I think we can move to questions. We do have a few that have come in. I don't know whether you want to address any of those, Scott.
Okay, sure. Yeah. Well, we've got one that asks if we could provide any thoughts on how La Nina might impact the season. Will we now need a weather-driven rally to rally? I would say the answer to that is clearly yes, Darrel.
Yeah.
Yes, Mother Nature's going to have to help out to get any rallies. And what is the timeline to predict when it will happen and best opportunity windows? Well, first, again, let me put in another plug for the work that Darrel and I have been doing in the last month, looking at the impact of the current major El Nino episode in a series of Farm Doc Daily articles. I think we've written 4 now in the last month. You can find those all at our Farm Doc Daily website. And basically, where we're at is that the current El Nino episode, which for those of you that in the audience that may not be as familiar with those terms, is a warming of the water basically in the Central Pacific Ocean, and it's well known to have some climatological implications on worldwide weather. What our analysis showed is basically that the existence of a really big El Nino, like we're in now, the peak temperature anomaly of the current El Nino is one of the largest ever. And in particular, when we look at previous episodes of a comparable magnitude, we see this general tendency for some elevation of below trend yields compared to years when you don't have these large El Ninos. Of course, the big question, Darrel, is how much and exactly what is the elevation and the risks. The basic data says that on average, you would expect with these kind of El Nino conditions, trend yields to be 3 to 5 bushels per acre lower than you would normally, and the probabilities of getting into those below trend yields might raise from roughly, say, 20-25% to 35-40%. And that's just looking at the current episode in terms of absolute size of the current magnitude. A different and trickier issue is this question of transitioning. Basically, all of these major El Nino episodes are a physical process in the Pacific Ocean, and so the temperature goes up and it has to go down eventually. There's a very natural cycle to these things, and the question is what's going to happen in the current episode, particularly by the upcoming summer period. Is it going to transition into what's called a neutral or a no El Nino, La Nina conditions, or is it going to go all the way into a La Nina, which is kind of the inverse of an El Nino? It's instead of much warmer than average waters in the Pacific, it's much cooler than average water in the Pacific. And there's a bit of evidence that we've uncovered for corn and soybeans that in El Nino transitions, you can have some of your bigger summer droughts and major problems with corn and soybean production. But that's certainly far from a sure thing. Sometimes you read about commentary in this area and you can get the impression that if we would transition to a La Nina by, say, June or July, that look out, there's going to be a big drought. And the data is really not that clear. It, again, I would say just kind of confirms our first analysis that there will be some elevated further risks of poor summer growing season weather if we do transition to a La Nina. But again, it's not a slam dunk.
Okay, we have a second question on corn export sales. We've seen week-over-week sales beating the numbers of last year for several weeks. Do you expect corn exports can achieve the USDA's forecast? I did address that briefly, and I think the answer to that right now is yes, based on both the pace of sales and the pace of shipments. We can reach the 1.65. Another question on with GMO labeling on the increase, what's the expectations for area planted to non-biotech crops? I think what we will see for 2016 is a reduction in planted acres of biotech crops because of the sharp decline in wheat acres. So when you look at all crop acres, that percentage that's biotech or will be smaller. I don't really see much of a accelerated trend in reduced acreage of biotech corn and soybeans. There are some premiums for non-GMO crops at this point, and farmers are taking a closer look at that. I think if we will see an impact, it will be more in 2017 than it will be this year.
Mm-hmm. I want to jump back to the El Nino, La Nina, and one of the questions, and I don't think I covered one of the parts of that question, which is kind of the timing and the windows. Basically, I think a key thing to monitor with regard to that phenomenon this year is just how fast the transition is going to occur. We know that the current El Nino is dissipating fairly rapidly. And what we want to watch is, does that transition all the way to La Nina conditions, particularly by June or July? Basically, the earlier you get the transition, you get a little bit further increased risks of poor growing season weather. And what that means in kind of timing is, though, kind of a pattern that I know I've kind of got in my mind, Darrel, for an analog. Right now, it looks like the closest analog to the weather pattern so far that we're seeing in the U.S. Corn Belt is 82, 83. And of course, those that have been around a while know that the summer of 83 certainly wasn't very friendly, but it basically was a warmer than average winter and a kind of cool and wet spring, and then it turned off hotter and drier in the summer. We've obviously got a long ways to go. That's not a projection. I'm not a weather forecaster. I'm not saying that's going to happen, but that's what we need to monitor. But basically, in terms of windows and any kind of rallies, obviously with the kind of acreage that we're seeing on corn, and with normal trend yields, the yields that are possible, I don't see much chance of any kind of significant rally, Darrel, until we might see some of those El Nino, La Nina inspired kind of weather events starting in the second half of June and into July. It seems to me there are some other things going on in the markets. We'll have to watch for continued potential planting delays in the Delta. But that, at least in terms of corn, that's not the big area of corn production. So it's kind of hard to see much of a window of an opportunity until we might get a weather rally, maybe starting the second half of June.
Good. Let me jump to another question here on corn stocks. The observation is that on-farm stocks were a bit smaller than last year. Does that imply producers have sold more than is commonly perceived? I would say don't read too much into that number. First of all, it's based on a sample of a survey of a sample of farmers, and 40 million bushels is close to a zero change and from a statistical standpoint. And the second point is that we don't know ownership of grain based on where it's stored. So corn on the farm could already be priced corn off the farm could be farmer owned. So it's hard to argue that the on-farm inventory tells you too much about how much of the crop farmers have sold or still own.
Maybe I'll jump into this one question. Darrel says, one person asked, do you think this report has opened the door to retest the low in corn at 318 on the weekly chart last September? I would say that the answer is it opens that possibility if we would turn out to have decent summer weather, and which would potentially give us a pretty high chance of corn yields in the upper half of the 160s, 165 to 170. And it's important to remember, going back again, there's so much discussion on El Nino, La Nina, there are examples of years when you have had major El Ninos and even transitions where you get above trend yields. Now, it's very, very unusual for them to be much above trend with these kind of weather circumstances, but it's certainly not an impossibility, which says that, you know, something from our 166.2 to 170 is a realistic possibility. And that, you know, it's certainly possible that with a good growing season weather this year that you could see that ending stocks for corn go above 2.5 billion bushels. And that could be a formula for testing those lows from last fall. But it would take above trend yields, I think, to do that.
Okay, continuing down the list here, we do see a question about if corn and soybean acreage does change from intentions, where might that happen, in the Midwest or the South, or where? I think what we would say, first of all, is the intended corn acres implies a lot of corn on corn from last year. So I think there is opportunity where inputs have not yet been applied, that farmers, even in the Midwest, could still change their intentions from corn to soybeans. We do hear some of that chatter. Just anecdotally, we know that there's opportunities to do that. And my sense is that at the margin, there certainly could be some acreage shifted that particularly where nitrogen fertilizer has not yet been applied to that corn on corn. Secondly, I think the plain states, northern plains, is an opportunity where spring wheat would probably come back into the mix. You hear some chatter about with the price response we're seeing, corn lower, soybeans steady, wheat prices higher, that we might pull some additional spring wheat acreage back into the mix as well. So history would say that it might not be any one particular area that would dominate that, but I think there are opportunities, Midwest, plain states, probably less in the South, but 1.5 million acres shifted would not be a big move, and I think certainly is within the realm of possibilities.
Had a quick question asking on our price projections on corn, 350 or 370 for corn. Is that a farm gate price or a board price? That is the average price received by farmers. So you consider that a farm gate price rather than a board price. So you'd have to add a basis to that to get to the board.
Yeah. We have several questions about marketing strategies, whether this is a year that we would use some kind of option strategies in order to protect the downside risk going forward. I don't know whether Scott might have some thoughts on that, but I would say as a starting point, those decisions, I think, would be influenced to some extent by your crop insurance decision, what kind of option strategy you already have in place with a high level of revenue insurance that does provide some downside risk on both prices and yields. Beyond that, is there an opportunity for applying some kind of option strategy in the current market environment?
Yeah, that's tricky. My philosophy on these kind of questions is to keep it pretty simple. I like to use the crop insurance guarantee as my starting point for thinking about your marketing, and the vast majority of farmers, at least for corn and soybeans, are in that 75, 80, or 85% range in terms of the revenue guarantee. And so you've got relatively few bushels unprotected from any kind of price downside movement below the February average. And so I don't tend to recommend getting too aggressive with your marketing for any prices below that price. And then you really are faced with important questions about where do you really start your marketing, or kind of looking for those opportunities to put them in the form of an option strategy. I use kind of a just rough rule of thumb that I'm looking for corn prices on the board to be 25 to 50 cents above the February average before I get very excited about marketing a lot, and on soybeans 50 cents to $1 above. Otherwise, I know I'm pretty well protected from with that revenue guarantee. And from there, then once you hit those targets, then reality strikes and you have to make some decisions.
Let me jump to a relatively straightforward question, and then I'll ask Scott to address a more complicated one.
I see that one coming, Darrel.
Based on the maps, what are your thoughts for the reason for decline in soybeans in the Southeast and Delta? I don't have a copy of the planting intentions report in front of me, but I think what we did see was intentions to probably increase cotton acreage in those areas, and I would guess that's at the expense of soybeans. I can stand to be corrected on that if somebody has the actual intentions report in front of them. But the more complicated question is, can you explain your stocks to use price model? The current price projections that we showed don't seem to be consistent with some of our previous articles. So what's up with that?
Well, my somewhat flippant answer is tune into our Farm Doc Daily article next Wednesday, right, Darrel?
Right.
Where we're going to explain some alterations that we're making in our fundamental stocks to use pricing model. Basically, I have to give credit to my a good friend and mentor out to Cornell University, Bill Tomek. He's done some really interesting research in recent years about implying the demand for grain markets, and we have adopted his method, which basically, in short, you take the base period as roughly 1990 through 2005, and you say that that's your best period for estimating the slope of the relationship for stocks to use and price. And then in this new era that we've been in since fall 2006, early 2007, then you just you change the intercept to reflect the varying strengths and weaknesses of demand here in the new era. And this is the first time that we've actually begun to use this alternative way of modeling the supply and demand implications of ending stocks to use. Basically, what it means is that we're in kind of a low demand state of the new era, and it also means that you get a pretty flat relationship between stocks to use and price compared to the model that we were using, particularly on corn last year. And so that's why you see our corn price projections right now not being very responsive to either really big or even modestly smaller stock levels. So it's kind of a good and a bad news story there. But again, we will be coming out with a Farm Doc Daily article next Wednesday, right, Darrel?
Hopefully.
Depending if we can get enough sleep to have something coherent to say. But we will explain ourselves fully in print next week.
There is a question about what are the factors that are most likely that would change prices. In other words, what are the big movers and what's most useful to watch for the producer hedger? Certainly in the short run, the next couple, 3 months, the big mover and shaker is just going to be weather and yield prospects for corn, soybeans. At the margin, certainly currency values, economic indicators, gasoline consumption, all of those things at the margin are important, but the big 800-pound gorilla is weather and crop prospects.
Okay, let's see. Let me see if I can keep getting El Nino questions, Darrel. It says, is there a simple site or report for the non-techie to monitor El Nino transition? Spring is busy. Well, I certainly get that. And I want an email feed or reminder. I am not sure of an email feed or reminder. The site that I follow is actually for the weekly updates is actually from the Australian Weather Service. They have a very nice site, and that's where we have been getting our short-run weekly data that we've been using in our articles. One thing that you might consider, this is kind of a blatant plug for my own Twitter feed. I have an active presence on Twitter, and so if you're a Twitter user, you can go to my Twitter account, which is just at Scott Irwin UI. So that's SCOTTIRWINUI. That's my Twitter handle. And I fairly regularly will be updating the charts on the transition. Hopefully, I'm trying to think about doing that on a weekly basis. So that's one place that you can get some good data. But I'm not aware of any particular email or feed that announces it. But if someone else does, please submit that, and we'll publicize it. One more is, what are the odds we get a year like 1983? It says we burn up in Missouri in 3 days in August, 107 degrees, 30 miles an hour wind, 15% humidity. Gee, that sounds like fun, doesn't it, Darrel?
Not so much.
Basically, it's very interesting. 82, 83 was an El Nino of a similar magnitude to what we have now. But it actually transitioned somewhat late into neutral or La Nina. So that's kind of fascinating to show that it doesn't necessarily take a La Nina to get yield problems. Basically, in the 3 big episodes similar to this one, 2 of them were on average above trend yields by about 4 bushels. That's a little scary. That would be meaning that we could get 170 bushel corn this year. And the other one was 83, which I don't have off the top of my head, but it was like something around 25 bushels below trend. So that would say you've got about a 1/3 chance of an 82, 83 and a 2/3 chance of something near to above trend yields. And that's what we know.
Let me address a couple questions here. One is, how did this year's actual prices compare to your predictions from last year? Ouch. Prices were lower than we forecasted this time last year. Yields turned out to be much higher than we anticipated, above trend. Demand a bit weaker, stocks a bit higher than we were expecting. So for both corn and soybeans, marketing year average price will be lower than forecast. Second unrelated question is, what are the chances that low farm returns cause less use of inputs and would impact yields, I think very low chance of that happening on a wide-scale basis.
Yeah, I think that that's actually more of a longer run issue, Darrel, which is could you see basically some kind of measurable, notable aggregate impact of lower input usage, and in particular maybe even lower population. If we would continue in this kind of low demand, low price state, it's possible at the margin as we accumulate several years of this to have a small impact, but at most that would typically be negligible to small. Would you agree with that, Darrel?
I would agree. I think if you look at, the 80s as a comparable period, some people are talking about when we had a lot of pressure on farm incomes, you can't really see anything in the trend yields during those periods that would say that we had a measurable impact from reduced inputs. I think what you would see more than anything, at least initially, would be a move to crops that require fewer inputs, that you would see move to lower cost crops rather than reducing inputs per crop.
It gives me a little bit of a chance to plug a very old, but I still think an important model of, agriculture that I learned in graduate school all those years ago. Crop agriculture is a high fixed asset industry, and when prices are low, it's surprisingly hard to turn that machine off because you have such high fixed assets. Maybe a chance for my favorite question to always get, Darrel, the funds.
Yeah, let's end with that one.
Yeah. It says, the question is, funds are record net short corn after yesterday. Any thoughts on how that may influence corn price trends? I know this is contrary to a lot of market analysts, but I don't think that has any influence on price whatsoever beyond perhaps a few hours, maybe even a few days, marginally. I've looked at a lot of that kind of data, and I can't find any hard evidence of a relationship that's meaningful.
No, I think, from my standpoint, it seems to me that funds those folks are really good fundamental analysts, and what they do is they take positions based on the overall fundamentals, and they tend to be followers of price trends rather than creators of price trends. And again, that's, I think, consistent with what you found in your research, and contrary to popular opinion that funds move the markets. I think markets move the funds more than anything else.
Yeah. Amen to that, Darrel.
With that, I think our time has run out. We certainly appreciate your participation and the great questions that you've submitted, and we intend to repeat this webinar when we get the June acreage report and the June 1 crop stocks. So we'll update all this information at that time. Thank you.
Again, I'd add my thank you, and continue looking for our Farm Doc Daily articles. And you should remember that you can subscribe to Farm Doc Daily by email, Twitter feed for the project itself, my own Twitter feed. So lots of different ways that you can continue to keep up with what we think is interesting going on. And again, thank you very much for your attendance.